Welcome to Brick by Brick. Join me, Lauren Winnett, as I share my personal journey of building a thriving real estate and hard money lending business from the ground up. Along the way, we'll explore the strategies, challenges, and breakthroughs that come with growing wealth. Whether you're a seasoned investor or aspiring entrepreneur, or simply curious about the world of private lending and real estate, this podcast is packed with actionable insights, real-world stories, and mindset tips to help you build your own path to success brick by brick. Welcome to another episode of Brick by Brick. Today I am joined by Ari Rastegar. Ari is an Austin native and has been involved in raising hundreds of thousands of dollars for real estate in that space and currently has well over $1 billion in assets. He's got a very interesting backstory, but we're going to skip all of that and dig right into the meat of the matter, which is what is going on in real estate in Texas, how Ari and his company are handling that, and what we as the audience can learn from people with his skill set. So Ari, thanks for joining.
Thanks for having me, buddy. Look, this has been a very interesting past 5 or 6 years. And if we zoom out a little bit, I know everybody always hears that real estate happens in cycles. There's cycles. And what does that really mean? Well, there's seasons to the broader economic, how economies really work. And in fact, they're much more predictable or more easily anticipated than people think. So much so that we can go back all the way to the Babylonian era. What's happened over this last 5 or 6 years, we've hit several black swan events, effectively certainly for our lifetime. I'm a 43-year-old CEO. I started my business, started the Rastegar brand 11 years ago in February. And as you mentioned, our investors are public pension plans, insurance companies. We've invested in 38 cities, 13 states, 7 different asset classes. And these last 5 or 6 years have statistically been some of the most difficult years, in the past 50, 75 years, even more so than, 2008, for a variety of reasons, especially because COVID kind of started the fear factor and this kind of economic shutdown. And then it led into, the quickest interest rate hike at 500 basis points in the history of modern economics. And real estate as a whole is governed by interest rates. Interest rates are the govern, happen, which shutters the entire global economy. And then you take, a micro, not so micro, but a micro economy like Texas. And then you take that on top of cities that are growing like, Dallas and Austin and Houston, and you add all these confluences together, you start to create real stress on existing assets, on existing values. And again, the other side of the coin is it also creates exponential value creation in special situations, but there's other things that play into that in terms of the type of liquidity that you have, the way that you can transact. And then on top of that 5 years, which is another black swan event, is the entire reinvention of the office sector, which for the last 100 years has been the single largest investment vertical in all of commercial real estate globally. And to put it in commercial real estate as a whole globally is over 3 times the size of the stock market. So sheer volume and capital and commercial and residential loans dwarf what we see in the public markets as a general rule. So when commercial real estate or real estate in general hits these levels of stresses with all these other risk factors that we outlined, you talk about the value changes of different generations. So I'm actually a millennial, or the oldest millennial, and they created basically kind of a gap, a micro generational gap for, within the people that are within a 5-year age gap of me, called the Zillennials. Watch that change where people once saw Americans, the white picket fence, Cary Grant era, American dream era of owning your home and, saving up your money and then getting a pension, and retiring. This entire system, and we can pontificate about whether that's good or bad maybe another time, but it's changed and it's shuttered. People invest more in their camera lens, and value more their social mechanisms, their social circles, and their traveling and their experiences more so than getting that first job and getting married at right out of college and having their first kid, and their home becomes their retirement over 20, 30 years. All of these things together, and then you electrify it with the fourth industrial revolution of artificial intelligence on top of all this. To say the least, we are at a place of radical change, radical change. And real estate, the reason people invest in real estate historically for the last 1,000 years or so is the fact that it doesn't change so quickly. That ability to stay as a solid piece of stability when you see the stock market do these ups and downs and turns and headlines alter what happens on a day-to-day basis. And there's certainly a place for that. Real estate has this foundational piece of generational wealth creation over decades, if not centuries, because it doesn't change as quickly from a building standpoint, from the technology that goes into building, where now we have 3D printing and robotics, which we're doing in some of our projects. And then the way we went from fixed rate mortgages to a whole world of floating rate mortgages. This is 1,000 years of change in 5 years. And so when you take all of those things together, we're at a place where this traditional brick by brick growth, this systemic, predictable growth rate and change rate that we've seen in the cycles has been completely reinvented to a place where we've hit this J curve of accelerating growth and change, exponential growth and rate change, that we have to actually sit back and kind of build the bridge as we're walking on it.
I think the key thing I'm taking away is that as we look at all these changes that are happening, they're not just directly impacting, the money or the interest rate. They're actually impacting how people are behaving.
That's
and
right.
Those people behaviors that are changing, like less people are getting married, which is going to have a down trickle effect on how many less people are having children.
Too.
There's less, even when they do have children, they have one child, not 4 children. And where they want to live changes. Now they can live in a condo. They want to be able to walk to where they.
But pointing to the fact that it is evolving and changing, or has changed, is a matter of fact. And how, as investors, we manage risk, because that is the main point that I've learned in my journey as an entrepreneur. I'm an attorney by trade. And so my brain works very much within structure, within law. And it's why we've done so much work in entitlements and zoning and working with councils and seeing, because a law, on its face, is meant to reflect the needs of a society at any given moment in time. That's what a law is, to create order. Well, when you change that this piece of land that used to be a single family home, now I can build a skyscraper, that's saying something about that community. That's saying something about the city and the needs of that particular era. I think the takeaway, as you said very astutely, is things are changing. Value systems are changing. The behaviors that we have are changing so dramatically, and real estate at its best needs to be a reflection of those needs to fill what those needs are. And that's why we saw multifamily do so well during the time, is because people are like, well, why do I want to just buy a house and be stuck in this place? It's not like I have a 9-to-5 job that I'm going to have my pension at 65. I want a 1-year lease. I want to work from home, and I want to move to another place. I want to move to Dubai, and I want to run my company and be an influencer, or these things that didn't even exist. And as real estate investors, we need to be responsive to it, and at best anticipate those needs so that we can create long-term value for our shareholders, for our investors, and create the structure that's going to serve our customers, which are these tenants, which are these offices, and the small businesses that are in our retail centers and all the different asset classes that we serve.
Yeah, I think anticipating what those changes are going to be in the next 3 to 5 years, while also mitigating, and you mentioned this, mitigating risk for the unforeseen changes that are going to happen in the next 5 to 10 years, right? Because we have no idea what things are going to look like in 2035.
And I think that's right. And I actually think there's a lot of science behind that, is because the speed of change that's hit this J curve. So we talk about this growth curve, okay? Well, the thing about J curves, information technology doesn't just grow exponentially, it accelerates exponentially. So I would argue, as a founder and a CEO, that I run a fairly substantial company, and it wasn't long ago that I was delivering pizzas, by the way. So I went through 2 community colleges, and I'm a nobody from nowhere. But my point in saying that is we look historically at companies and say, okay, these are the quarterly earnings. Here's our 1-year budget. As a founder and CEO, I've started to look no further than 12 weeks because the things that are changing so much in front of us, even the policy changes that are affecting interest rates, are happening at such a speed that looking even a year down the road almost becomes an exercise in futility, because things are changing so much that these variables are changing, where it's like, look, let's deal with what's right in front of us. Let's restructure the things we need to restructure, find the deals that we need to find. But that system on itself is making it hard to anticipate something that is by nature unanticipatable, if that's a word, because something is being invented that you don't even know it exists. And that thing that you don't even know exists is inventing something new. So you're looking to 3 to 5 years, you're dealing with a place of so much unknown. And as investors, we try to control the uncontrollable. What are the things that we can wrap our heads around? Population growth. Population growth is one that we can look at, which where companies relocating to, where jobs are going to be, the nature of the government within certain states or countries that we can look to. And Texas, where I'm born and raised, although we've invested all across the country, in various capacities, various asset classes, Texas got big eyes on it 5-6 years ago, big eyes, and little companies like Tesla and Oracle moved their headquarters to Austin, Texas. The Gigafactory was opened in Austin. Now the New York Stock Exchange is now in Texas, in Dallas. These are seismic shifts that happen at best once in a generation, and that created a lot of exuberance in Austin. Austin's beautiful. It's on lakes. It was a sleepy little hippie town that, became this town on steroids, which created this huge pop, which thank God, helped our investors. And then that started to come down, pretty dramatically, which created a big change on top of it, which posed all its own challenges. But at the end of the day, Austin has 400 people a day moving here. 400 people a day. That's adding the entire city of Pittsburgh every 4 to 5 years. And so no matter what headlines or things say, the population growth, Dallas is on track on sheer population growth alone, which is the headquarters of American Airlines, AT&T, massive companies, is going to be the most populated city in the United States by 2035. And so when you talk about cities like Manhattan, New York City, you look at Los Angeles, look at these other, Chicago, nobody could have fathomed 40 years ago that Chicago would be devastated economically the way that it has been. Chicago is a staple of the United States. Like, when me growing up, that's Michael Jordan's home. Like Chicago can't go. San Francisco getting crushed the way it did and seeing the resurgence. So Texas has been the beneficiary of this because there is so much more Texas. So Florida has also been on this list because of no state income taxes, Miami, but there's only so much Florida, and yes, supply demand, that can drive value, but it's a very small microcosm of what Texas can have. And if you look at Texas, a funny statistic is if you took the density of New York City, okay, let's think and say, if we use the same density and zoning laws of Manhattan, okay, which is basically like, think Tokyo, Singapore, Manhattan, you could fit the entire population of the world in Texas. That tells you how big Texas really is, and it's centrally located. So geographically, back to what can't readily change, it's right in the middle of the United States. You can be right in LA, you can be in New York, you can be in Miami. You have this central located area, and then you're within the Sunbelt region that is fair weather climate. So these high level issues, although you'll see these blurps and you'll see the Austins get kicked in the teeth, these fundamental traits on the 10-year, on the 20-year, and the 30-year, which is well beyond a traditional 7 to 9 year private equity fund or investment thesis, so to speak, are not changing. And in fact, the population going into them is so dramatic that to bet against them it's like fighting a tidal wave. Those fundamentals are going to drive people. And it's why you're seeing people move there so readily, and why businesses are relocating, such as Goldman Sachs building their second largest office in the world, right in that uptown Dallas area, JP Morgan, the Texas, New York Stock Exchange. Like these aren't little changes. These are seismic shifts that need to be, that can't, if they're ignored, you're just going to lose under the current of the inertia of what's actually happening.
So is that the primary lever, just looking at that long-term forecast of people moving in
I think
to
so.
to reconcile I only can look at things at 12 weeks at a time because things are changing so fast versus this long-term developer mindset, like I've got to take this piece of ground, I've got to get it rezoned into whatever, and then I've got to go through all the process in order to get just to the construction phase. That could be a
I
2
think
to
that's the
5 year
only lever.
process.
I think that's the only real lever that I can really, because saying like the national average of multifamily, that is bullshit for how I invest in some neighborhood in Austin or in Dallas. Like that's nice, but but we're looking at things like back to Manhattan.
It's not how anybody invests. If I go to buy a house, I don't look at what the national average for a 3-bedroom,
Yeah,
2-bath
these are the
house
headlines.
is.
But these are the headlines that are governing, all the things that average Americans and people are looking at. The average interest rate environment, the national average of these are not. Yes, there's statistics. Mark Twain used to say, "There's lies, there's damn lies, and then there's statistics." And so this is one of those where you have to look at the micro economy. Yes, you start with, do I like the U.S.? Sure. Do I like Texas? Okay. Do I like Dallas? Okay. But Dallas is fucking enormous. Like then going to Uptown, and it's not even just Uptown portion. It's like what corner on Uptown connected, and then what's the replacement, discount to replacement cost. Then what are the rents within a 500-foot radius? And so really honing in on the exact location that you're trying to underwrite, in my opinion, is the only way that you can get to some formulation of what reality is from an investment standpoint. And if you're buying a big piece of land like we do, we own hundreds and hundreds of acres. We build master plan communities, single family rentals, multifamily. We just built a new school. Land, if people are coming in high density areas, I can make a great case that land banking or buying huge tracts of land around major employment hubs, that people are going, and I have to deal with the bureaucracy of zoning and commissions of this antiquated model of how permitting and things done, which is another discussion. Time can work in your favor. So you buy the land, you keep it. It might take you 3 years to get a shovel in the ground. I have one case in Dallas. It's taken 8 years to finish the zoning. Mind you, it's from 20 feet to 400 feet, and it's a big lift, but if you buy phenomenal pieces of land in great growing areas, you can then use that to your benefit, that by the time you get through all that red tape, there's an extra gazillion people that are in the area you would think that would then drive demand.
Yeah. I mean, if 400 people are moving to the area every single day, right?
At one point, that's and in fact, it hasn't slowed down even through COVID, through the time, through whatever. But that's the thing about real estate historically that's been so phenomenal, is that the fact that it doesn't change as quickly. And so I've tried to zoom out and say, do people want to be in Austin? And I'd say, ask myself, why? Say, well, okay, why would I want to be in Austin? I'm a single father of 3. So I think about my kids. I was like, well, it's on the lake. Okay, so people like the lake. There's beautiful trees. There's a great music scene. The breakfast tacos are pretty good. There's a young lifestyle. And I think, there's fun stuff to do, great entertainment, fine. And you think about what makes people from a psychological standpoint, from a sociological standpoint, want to be somewhere. And it's very simple. We as humans are not nearly as unique as we'd like to think we are. Certainly not in groups on the average. We like to have fun. We like to eat. We like to have a job, and we like to have a house that's not too expensive. And so between those things, these cities like in Texas, as we talked about offline, are loaded with them. And they're a lot cheaper than their counterparts are in some of these other cities. And does that mean it's great for everybody? No, but there's a huge tranche of people to justify that, because those things aren't changing. And there's major university hubs like University of Texas that are good at sports. People like that too. They want the, and everybody looks good in burnt orange. I'm an Aggie, but people look in burnt orange. I saw that look, Lauren. I could
Yeah.
care less. But my point is, but those things together, I believe, are the longer term reasons that I could bet the ranch on that hedge against all the exponential growth and change that I have no fucking clue what's going to happen.
Yeah. The other piece you didn't mention is people like to be where people like them are at. And so I think you see a huge amount of elderly people move to Florida because that's where elderly people are. Austin, you have young professionals. And what do you get with young professionals? You get smaller families, higher income. You have more young professionals move in. It's a flywheel effect.
Great nightlife.
Great nightlife.
And great nightlife. And you're right. And people, birds of a feather flock together. Use whatever, cliche that you want to do. And I think the weather also is a huge component. And Florida has seen that. The reason New York has such a long-term relationship with Florida, and that's why Florida went crazy at the beginning, I believe, is because there already was this symbiotic relationship between New York and Florida. When you hit a certain age, you retired, you didn't want to be in Manhattan anymore. You didn't want to deal with the 4 feet of snow in the winter, you move to Florida. And so since that was already there and 14 million people in Manhattan, just Manhattan alone, once the world started to shift in COVID, a lot of those folks that had a little bit of savings said, fuck this place. I'm going to Florida now. So there is like success or movement like that leaves clues. Like there's still breadcrumbs, that we can follow along the way, to your point of community. And then from a real estate standpoint, building these huge master plan communities, which has really become something that we're very focused on, of getting massive tracts of land, hundreds of acres, and then, that are agricultural land, and building green space and single family homes and apartments and commercial and schools, and really looking at a high level. The same rules apply to building a master plan community as the reason people move to big states and big cities. They're similar. They need a place to get their coffee. They want to get some barbecue. They want to walk their kids to school. They want to be able to walk in the park with their dog. And so these rules, I think, as long as we stay very cognizant of those rules as investors at a massive scale, those things still apply to some degree, to your point of all the things that are kind of changing in the 12 weeks. And I look at investing in real estate through more of a Berkshire mindset of saying, although we absolutely buy, build, and we want to sell and monetize within a reasonable period, clearly, but I always do ask myself, would I keep this forever? Like, is this a piece of land? If I bought 300 acres in Kyle, Texas, which is just south of Austin, just north of San Antonio. So just Austin, San Antonio, you don't need to know where it is, but if it's in between those two cities, you can tell there's a lot of people. I said, well, if I bought 318 acres here and I didn't build anything, would I be mad in 30 years between those areas as much as they're growing? No, I'm good. And so I like to keep would we want to own this asset forever? Do we believe in this community forever? Do we believe in this market on the 10-year, 20-year, 30-year, and then be prepared to sell to monetize, when the numbers fit? So you're still having this forever focus in some regard, but tempering it with all the other things that we're saying, which is now has a little bit of art to it as well as science, because of how unpredictable things are.
Yeah. Speaking of art, talk to me about how you mesh the difference between the speed of government, especially with UDOs and how the government's changing those, with the speed of which our customers need new properties built, or the demand for new homes, or the demand for these neighborhoods.
Well, look, put it this way. So simple numbers. America is 5 million single family homes short. 5 million. Texas, for all its growth and all its leniency on building and construction and no income tax, state income taxes and whatever, is 500,000 houses short. So the insatiable need to continue to build housing, even with the reinvention of our value system and this move towards renting and things, that we're still that short. So we have this massive shift where things change, I think, more out of desperation than inspiration. Maybe I'm become a little bit more cynic in my older age with a little more gray hair, but for that reason, I can give you an example of something that we're doing on 2 of our sites. One in Central Austin, there was an old apartment complex that we're scrapping and kind of rethinking, reimagining, which is our core business, through zoning and entitlements and things like that. And it's why we have such a breadth of asset classes, because we look at the dirt and the use and then bring partners in to to explore the development, etc., is we're starting to 3D print houses, and 3D printing houses, which sounds like something out of, a Brave New World, now has become very applicable and very real from a cost standpoint, where if I can't change how quick zoning and the government does the process, if building a single family home, a Lennar DR Horton house starter home would take 6 to 9 months. Let's just use a timeline. Okay. We can build the same house effectively, cheaper, higher quality in 6 weeks. So when you factor that against higher financing costs, higher interest rates, you can then maintain a margin that is still within the parameters of single family home, build to sell model. But if you can build it in a seventh of the time, your financing costs are lower and you can move to transact quicker. And as I said, the quality is astounding. Like I had to see it with my own eyes over and over again. There's a couple big shops that are doing it, or growing shops that are doing it here, to where we're like, my God, for me to build 500 of our build for rent strategy just on the Kyle site, it's like, this is going to take 2 years before we get through all the stuff, all the horizontal development's done. The lots are fully finished. But if we can go do them in 6 weeks, we can put up less cash, we can get more accretive financing, and we can build a badass product that especially the Austin forward-thinking techie group think it's cool too. So the marketability side of it becomes interesting, but that has become as a matter of necessity that we don't necessarily have to wait as much. It'd be nice if the governmental permitting processes are expedited, and I'm not holding my breath just yet. And again, bad or good, that's another discussion. But if I can build them quicker and build them better and build them cheaper, hey, I can start to serve my customers in a more meaningful way.
Right. And put a product out there that is just being clamored for, right? This kind of lower end product, I wouldn't say lower end in quality, but lower end in price, starter home. It's a starter.
It's essential house. So people talk about affordability and this, that, and the other. And affordability is so relative. Like that's such a relative phrase. So I've kind of moved towards the phraseology of essential housing. There is essential housing for folks that want to get into something that they want to own. And there's a certain level of that, a certain income threshold based upon your age and things. And so what we are talking about, or what I'm talking about with regard to the 3D printing, these are essential housing level products.
Yeah. And I think that gets to the crux of the issue. I hear we need to reduce interest rates, or we need to, prevent institutional investors from buying all this crap. And the problem is there's not enough damn houses on the market. If you get enough houses, then the price will have to come down, supply and demand.
Let me tell you the institutional buyer thing. Mathematically, it's asinine. And the reason why is institutional buyers at their peak own 60,000 houses, 80,000 houses. There's 128 million homes in the US. I mean, so like my mind is, well, if people are just buying and building and they're figuring a way how to do it, like we need product to be out there. And plus the numbers are so low in percentages that it's an irrelevant mathematical discussion. 60, 80, 100, let's say it's 1 million houses. So it's less than 1% at 1 million homes. And we know it's only a couple 100,000 at best. That's not the line of, we can use our headline space and our airway space to discuss much more substantive issues than banning institutions from buying houses.
It's a scapegoat to take the eye off of what the real issue is, which is you need to put better legislation in place to allow builders to do the thing that they do, which is build homes.
Well, and I'll tell you the other thing about it. And there's an old country song called Politics, Religion, and Her. And at this point in my life, there's some topics, politics, religion, and her, I just kind of put over here because I'm sure a lot smarter people can deal with those issues. But the thing about the administrative governmental changes for housing is they're so locally governed. So it's not back to the national average. So the national ordinance, yes, I think can be important in certain ways. There's ways to do it. But what the local governing body of Kyle, Texas does, and how their council works, how their local government works, is apples and orange to Manhattan. So there's changes that need to happen with how their databases are run, how their documents are processed, the budgets that are needed. So it's a much more complicated issue in fairness to change, where it's easy to say, you need to go faster in zoning. Well, like there's like that's also not fair either. Like there's other things that go into how that is, but there are some policy changes at a national level. Like, for example, one of the reasons interest rates were so low for so long is that Fannie Mae and Freddie Mac owned $1.5 trillion of mortgages on their balance sheet. When they were buying $1 trillion of mortgages from all the local banks had more liquidity, spreads tightened. So the other day, I saw the administration talk about buying $200 billion in Fannie Mae using their balance sheet to buy $200 billion in mortgages. That initiative, it's not enough, because $200 billion would probably move rates down 15 basis points, 20 basis points at best. But if they use their balance sheet to go back to its peak in 2022, 2021, when it owed $1.5 trillion, that would substantively and systemically lower rates by almost 200 basis points. So in my mind, if there's going to be a policy change, go tell Fannie Mae and Freddie Mac to go buy $1 trillion in loans and free up all the local banks and free up all the other things to take that money and put it back into the economy.
And do you think if that happened, and this is projecting, right, where would the biggest winners and losers be on it? I'm going to say the word.
The American people would be the biggest winners. I'm dead serious. I'm not being kitschy. I say that because what would happen, so the Federal Reserve, okay, lowering rates. So when people hear lower rates, they hear that. Lower rates, lower rates. The only thing the Federal Reserve can do is lower the short-term interest rate, the federal funds rate. That's the only thing they have control over. Okay. But mortgages on single-family homes and most commercial real estate are based on the 10-year treasury rate. The 10-year. Okay. So what happens is if you lower the federal fund rate quicker than the forward-looking curve is projecting, go with me here. You do it quicker, artificially, that spikes the 10-year because it scares the market. So lowering rates is also not the answer, because that's the only thing they can lower. We need to do something in a way to prudently, systemically lower the federal fund rate, yes, based upon a slew of other issues. But in order to really move the 10-year, there has to be more liquidity in the marketplace. And to create more liquidity in the marketplace, we have to do something that buys those mortgages back. And as far as I understand, I am not an economist. There's people way smarter than me that can think about this. But very simply and linearly, Fannie Mae and Freddie Mac, or the government in its various capacity, buys these mortgages back to their balance sheet and holds them, spreads tighten because the demand for those mortgages goes up so dramatically and supply starts to dwindle, and there's more liquidity to go do this. And that will lower the 10-year just by economic nature.
Where do you think the 10-year and the mortgage rate stabilize out at, or have we reached that?
Oh, hell no. It needs to go way lower. I mean, I'm biased, but I would say based upon the latest inflation numbers, and the CPI as an example is mostly housing, okay? And in order to get those 5 million houses built and convince home builders to build them, meaning that they can procure accretive financing to do that, I think we would be in a safe place where the economy is moving, where builders can build, we can keep up with the demand for multifamily and single family housing, with 150 basis points dropped on the 10-year, which is not inconceivable, by the way. There's a very clear path to get there. With the new chairman that'll come in May, working on lowering that federal rate, buying some of these mortgages and some other acts that can be done at a higher level. 150 basis points down makes the numbers pencil for more multifamily development, makes the numbers pencils for builders to start buying lots and building houses more. So it doesn't need to be a crazy number. Rates don't need to go to zero, but 150 basis points would unlock the market in a meaningful way that is also not reckless.
Yeah, I think that would be a huge difference. We've seen just I wouldn't call it unlocking, but a de-thawing of the market just in the last month and a half since We've seen 30 years. Part of that seasonality, right? We got past December when everybody was shut down, got into January, and things are more busy now for me than they were in September through December.
But this is also a time, man, where if you got access to deal flow and people are freaked out, if I'm an accredited investor right now and I have money in a self-directed IRA or something where I'm not looking to fix and flip and be out in 1 year, I'm saying someone reasonable, hopefully that is a financial advisor before, that looks at their portfolio and says, look, Jim, Sally, you can put 200 grand into something and you can set it and forget it for 5 years. And if it took 7, it wouldn't break the bank. But if it does work out and you hit a meaningful double-digit IRR, it helps. This is the time. Like, this is the exact time to make that decision, but not with the, we'll be in and out in whatever. And, we're going to just build this tomorrow and sell it. Like, that's also not the time. And those aren't the clients that you want. You want the people that, me personally, we use our accredited investor base, which is substantial and growing every day, to co-invest alongside the institutional groups and some of the bigger deals we do. And I love when they have advisors and stuff where they come to me and say, look, my advisor told me that I can put in 150 grand and I'm good for, like, so when they have the reasonable expectations, I can do my job and I can put them in the thing and deal with the unforeseens and then get through the 3-year, 5-year, 7-year timeline, and hopefully walking away with a multiple on equity that's helping them with their entire.
Yeah, that we deal almost exclusively with accredited investors, and it's the same story all the time. Well, I was thinking about doing some flipping or whatever. Like I talked to a guy right before this call. He makes $500,000 a year, and he's like, "Oh, I think I'm going to be flipping." I'm like, "Are you going to be better served focusing on your career and just letting me?"
Let's say you flip a house and you make 100 grand. Just using a number. You got to pay short-term capital gains taxes. Who the fuck wants to do that? There's other parts of it where I'm going to buy 2 houses and renovate them. How are you going to manage them? What are you going to do when the tenant calls you and the water breaks inevitably? There is nothing passive about passive income. Nothing. I would know that across all the apartment complexes, it is a active business. So if you want to be in real estate, find great operators, do your diligence on the firm, that what they're doing, write the check, be a limited partner, and let somebody else do all the work, make your promote, be happy, focus on your job, make more income, and that's it.
So if somebody's interested in reaching out and finding out more about what you guys do, if they're a accredited investor and want to find out that, how would they get a hold of you, Ari?
Sure. They can reach us through, we're fairly active on all the social media platforms. You can go to @Rastegar Property on Instagram, or @Rastegar, my last name. You can find us on LinkedIn. You can Google Rastegar Capital. What we've done is fairly visible, good or bad. And what I'm very proud of our team is, your call will be answered. We have real people that have been with us for years and years and years that will answer your calls. We'll talk you through it. We use a third-party fund administrator that, handles all the stuff. And again, all investments have risks. Things go up, things go down. But I'm very proud that we have, very institutional risk controls in place. Our team is very personable. They'll talk with you. They'll answer your questions, and they'll be the first to say it's not for you. And that's another part of it, where this is a marriage. I don't want somebody with us that's calling every 3 days and saying, well, this was supposed to be done in 6 months. We want people that we can well educate the process. Some of them aren't, they don't want to necessarily hear it could take 3 to 5 years to double or triple your money, but that's reality. Does it happen quicker sometimes? Sure. But if you're not psychologically prepared or liquid on your own to have 3 to 5 years or even 7 years, barring these pandemics and things, you're not a good fit. You shouldn't do it. Go buy an index fund, call your advisor, put your money in a treasury, but please don't start flipping and stuff when you have a full-time job, because you're going to lose all your fucking money.
Awesome. The last little bit here, anything you want to leave the audience on, any little bit of tidbit of information or advice?
Yeah, well, I think everything we've covered is, educate yourself, man. Like, there's so much great stuff on YouTube. Do your homework on the operators, and get in the market, because time is what makes you money. Compounding returns, time in the market, money just sitting in a checking account. If you're an accredited investor, like I said, whether it's us, whether it's Lauren, whether it's your financial advisor, you need the money to work for you. You spend a certain amount of time earning money, but I look at money as an employee, and I ask it every day. What have you done for me today? How much money have you made me, Mr., Miss Group of Money? How much have you made for me today? And find a way to be in the market and let time do the compounding. And right now, real estate has got a bad rap for a variety of reasons, that some of them are systemic. But the times when the markets are down, if you have the right operators, the right managers, this is the time to invest, not when everybody is running into everything and just buying whatever they can when money's flowing. That's when people are just doing deals. This is when you find out who are real investment managers.
100%. Cash in the mattress is losing value every day.
Yeah. Well, according to the Fed, it's losing 3.5% a year just to inflation.
Yeah. So awesome. Ari, thank you so much for your time, your wealth of knowledge. I hope anybody that hears this is interested, reaches out to Ari and his team, learns about what he's got going on. I will make sure all of your links and contact information is in the show notes. And thank you all, and we'll talk to you again next week.
Thanks, Lauren.
Thanks for tuning in to Brick by Brick Wealth Building Conversations. If you enjoyed today's episode, don't forget to subscribe and leave a review. It helps more people find the show. For more tips, resources, and updates on my journey, follow me on Invest with Lauren. Let's keep building wealth, one brick at a time. See you next week.